The sun is the same in a relative way, but the stock market bubble is one day older and closer to a bear market.
Gosh, Stu, even I'm starting to feel now the daggers that are coming out of Mark's eyes towards us over this side in terms of, this bearish challenge to the bull outlook.
Oh, the bull to the left of me is not going to be happy with the start in the year like this.
2 decades of negative interest rates created one of the biggest trades in history, the yen carry trade. I think the biggest estimate I've seen is as much as, 15 to 20 trillion. I mean, this is enormous.
It's always nice to have a little bit of a pot to step in when the market comes off. So, yes, I turned bullish, but it's nice just to know what the risks are on the horizon.
Once a bear, always a bear.
Investing is an art. It's not a science. We can't tell when these things will happen if they ever do. Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Happy New Year, everybody, and welcome to the 2026 Year Outlook Special Edition of The Art of Investing, brought to you by IG, the global investment platform. Now, if your New Year's resolution is to learn more about investing or to construct that perfect portfolio, you're in the right place. Joining me today are Mark Spice Holden, Chris CJ Fellingham,
Hey, Rich.
and our expert economist, Mr. Stu Thompson. So no doubt you've already heard many a market outlook for 2026, with every bank putting their price target for the S&P 10 to 14% higher, and you don't really learn anything. Well, not here on The Art of Investing. We are going to bring you the themes that you could see throughout this year. Our top economist, Stu Thompson, is here to run you through all the risks that we could be seeing to our portfolio and the global economy in 2026.
Yeah, I think it's important to emphasize we're talking about the themes today. And then what we will do is we'll take those themes, discuss them over the next few weeks, and filter those into our portfolio construction to make sure we're ready for all those difficult squalls that always happen within the investment markets over any year.
CJ, do you want to take it away, Mr. Chairman, sir? A very happy new year to you.
And to you guys. And let's hope it's as good a new year as the last 6-9 months were for us in terms of our portfolio. So it's a pleasure for me to welcome back Stu to this fantastic forum, this center of wealth creation known as the Art of Investing podcast. I mean, should I say the award-winning podcast? And can I just say to everybody, you're only 1 month into the year, so you've got another 11 months of us milking this as best as we can. When we were working at the number of places that Stu and I have worked together, we would always, towards the start of the year, think about what are the big themes that we would expect to be driving financial markets over the next 6 to 12 months. And what we would try and do is get away from the sort of knee-jerk, what's everybody thinking about for the next week or the next 3 weeks or the next 6 weeks? What are those big themes that will actually drive asset performance over that time? So, Stu, setting up there for the really easy questions to start 2026 off, what are the 2, 3, 4 key investment themes that you think should be central to the way we construct our portfolio?
Well, let's take the consensus first, because the consensus outlook for 2026 is very benign. People are looking around the world saying, stimulus in America, stimulus in Japan, stimulus in Germany, boosting Europe. Even the UK, the tax hikes come later. We got some stimulus in the UK. Growth is looking better.
So when you say stimulus, though, just so everybody
this is fiscal expansion.
So you've got countries around the world pushing money into their economies to try to get growth better. And keeping inflation reasonably well under control. That's the consensus.
That is the consensus.
Okay.
So you've got, the impact of lower interest rates from this year. You've got, government expansion in terms of fiscal policy. Markets are complacent and happy about growth. There is no risk of recession in the consensus eye. But for me, there are risks. And the risks come in what we talk about, this competition for capital. The rising government bond yields, particularly rising yields at the longer end of the government bond markets. That is investors demanding a higher risk premium to lend for longer to these governments.
Oh, the bull to the left of me is not going to be happy with the start in the year like this. Would you like the yellow card, sir? I think you're going to be dishing it out at some point.
I know how to come back at this.
and the way I would phrase this is, in light of Rich's recent conversion to the dark side of equity bulldom, I want to misquote from The Dark Side of the Moon, Pink Floyd's seminal album. And the sun is the same in a relative way, but the stock market bubble is one day older and closer to a bear market.
Gosh, Stu, even I'm starting to feel now the daggers that are coming out of Mark's eyes towards us over this side in terms of, this bearish challenge to the bull outlook.
I enjoy a good challenge.
Good man.
Let's put it like that.
Okay, we'll get to that in a moment.
I'm just going to start putting my gloves on.
No, we're living on borrowed time. But to quote Chuck Prince, the infamous head of Citibank in 2008, while the stock market keeps rising, we all keep dancing. So the question for 2026 is, when should we take time out? When should we save our capital for the next dance? And that will be dependent upon rising interest rates and when interest rates rise. Now, one of the themes for the triggering of rising interest rates is Japan. Now, the rise in interest rates has been this year in Japan, formerly through 3 decades of lost growth, extremely low. They have started to rise as Japan has got growth. Next year's stimulus will add to that. And as we saw from last month, higher interest rates are here, and we'll see more from the Bank of Japan during the year.
So just for context for people, a number of people hear the word Japanese bond market yields, but actually they had never followed the Japanese bond market. Japanese bond yields got negative, didn't they?
Yes.
So we got a situation in Japan where growth was so terrible that interest rates had to go negative.
How does that work?
Well, that's a very good question. But basically, you paid to borrow from them. What? But that's what happened. It happened in Europe as well, actually, but we can leave that for another day. I'm just trying to give some context. So they were minus a quarter. I don't think they get any further than minus a quarter. Was it minus a half or minus a quarter? Well, I'm not sure. It was negative something. And now they're gently moving up. And that's what you're saying is they'll reach a point at some stage. I'm putting words in your mouth here. Please tell me if I'm wrong. Where when it gets to that stage, whatever that stage is, then money will be pulled into the Japanese stock market from other asset classes, which will lead to problems in other areas. Is that what you're saying?
Across the world.
Across the world, yeah. Yeah, so globally, yes.
Yeah. 2 decades of negative interest rates created one of the biggest trades in history, the yen carry trade. So this was where investors borrowed in yen, effectively got paid.
Yep.
Got paid to borrow in yen and took that money and invested in high yields elsewhere in making money on that differential.
So they have to sell their yen to buy a dollar to invest in an American asset.
Yeah. Now, in the last couple of months, we have seen yields in Japan rise, but the yen has continued to weaken. And this is part of what they call the debasement trade, the debasement of fiat money. And we're seeing, the weaker currencies, Japan being the most obvious example, due to the debasement trade, fall on a relative basis. Now, when yields rise to a level which the Japanese pension funds, the Japanese insurance companies feel is acceptable for their long-term needs, they will start to bring that money home, because obviously the risk that they take, the foreign exchange risk they take on overseas markets can be eliminated by bringing the money home. The reversal of that yen carry trade can lead to rising interest rates around the world, driving this competition for capital. When the Japanese saver is no longer providing all that money to the rest of the world needs to increase its competition for capital. It needs to get money from other places, and it needs to boost those savings rates.
Okay.
But could it also result in central banks in other parts of the world, like America? And we've seen, obviously, a couple of weeks ago when we saw the Federal Reserve change from quantitative tightening to quantitative easing. Wouldn't that potentially, if they were worried that their bond yields were going too high too quickly, then start to intervene themselves to control those bond yields from going too high by printing more money, doing more quantitative easing, which would push more money into their system? And ironically, that would be good for equities.
Oh, I knew that. I knew. There were so many holes in that argument. It's like a piece of Gouda cheese, as far as I said. And I've eaten too much of that over the last few days as well.
Yeah. Or is it yield curve control?
Well, absolutely.
It's the same. It's the same thing.
It's the same thing.
It's absolutely. I want to go back just a second before we go into that, because I think those are good things to talk about, just for our listeners, just to make it clear what Stu's saying. People have been borrowing in yen, swapping those yen, let's say, into dollars, and buying treasury bonds. Now, their big risk there is the currency moves against them, that the yen strengthens. The yen hasn't been strengthening. The yen has been pretty much unchanged, may have weakened slightly. It's not really moved, right? So they've made a massive amount of extra return. At some stage, if Japanese bond yields keep going up, that will then start people saying, the currency's looking more attractive, the yen currency, I'm going to buy some yen. And the problem is there's a lot of people short of the yen into the dollar. So then what might then happen is you see a strengthening of the yen that leads to people saying, I'm going to sell my dollars to buy more yen, and you get a reversal. Now, this hasn't happened for years. We know the fault line is there, but because the Japanese have been printing money and keeping their rates very, very low, it's not been so much of a risk. So number one theme then, I think what you're saying is Japanese bond yields go up quite a long way.
Yen
from
goes
here,
up.
the yen strengthens, money gets sucked out of global markets, away from them, back into Japan, leaving problems for the things that have been sold in those other markets. Is that what you're saying?
Yes, and you're already starting to see some anticipation of that in those markets which were big beneficiaries of that yen carry trade.
For example?
Australia, New Zealand, they have seen quite substantial yield increases over the last month.
So their bonds are selling off, prices are going down, yields are going up as people take their money out of those countries back in. Okay, that's interesting. Sorry, Rich, you're trying to get in.
Yeah, do we have any idea of how big the yen carry trade is?
There are various estimates. I think the biggest estimate I've seen is as much as 15 to 20 trillion. I mean, this is enormous trade. And it's a leverage trade, which, of course, once these currencies start to move, that leverage gets rapidly unwound. Now, potentially big moves, obviously, central banks will be forced to step in to slow the move. But, central bank intervention doesn't change currencies. Doesn't change currency direction, because if the economic fundamentals are driving the currency in that direction, all the central bank could do is spend a great deal of money to slow the pace.
So to stay with your theme of dancing, seeing as that's what we've been doing for the last couple of weeks, I'm sure.
I can't dance anymore. I'm too full, mate. Turkey and everything else.
Perhaps everybody that's in this yen carry trade, it's still been paying well. Mm-hmm. Are they dancing close to the edge of the dance floor and they're ready to hit the exits?
Oh, yes. I mean, we have a saying in the markets, the road to hell was paved with carry.
The other expression, of course, is picking up shilling coins in front of a steamroller. So let's just finish on this theme, but let's just say, if we thought this theme was something that we should be thinking about, how should we position ourselves? I'm reading from what you're saying that one of the ways you could do it is buy the Japanese yen.
Yes.
Because the yen will move swiftly. So you could hedge some of your portfolio by buying yen out of sterling, is one way you could do it. I'm presuming other ways are reduce some of the equity risk within your portfolio. Is there anything else that we could be thinking of as a longer term sort of type of thought on that?
Yes. I mean, you're looking at the higher risk currencies, weakening against the yen. So you're talking Australian dollar, New Zealand dollar, US dollar, weakening against the yen.
So going long the yen is probably your favourite way of doing that.
Going long yen is one of my favourite trades of the year. But also, again, this yield curve steepening with, investors demanding a higher risk premium. We're holding the longer end of these markets in the absence of Japanese savers.
Now, for our friends who are listening to this, how do you put on a yield curve steepening trade? And if you're in the markets, that's an easy thing to do. For people in the investment market, it's more difficult. You have to buy an ETF linked to shorter bonds and an ETF linked to longer bonds, or short one and buy the other. So I think probably for our readers, for our listeners, the best thing is to be going down the yen long route out of other things.
I was going to say, I mean, we've got a position in the Nikkei 225. If there's money coming back to Japan, not all of it will go into Japanese bonds. Some of it will go into their equity market. And if you believe the yen is going to strengthen as well, that could damage their exporters. And we talked last week or a couple of weeks ago about how sensitive the Japanese stock market is to exports. About 70% of their earnings come from outside of Japan. So when the yen strengthens, that actually ironically can hurt some of the profits of the Japanese companies. But all things being equal, that extra money going into the stock market should help the stock market maybe relative to other markets. And if you have it unhedged, like we have it totally exposed. So any money we make in the Japanese stock market, we make in yen, which translates back into the pound, and we make more money that way. We would want to stay unhedged. We'd want to remain exposed to that Japanese yen if we had a position in Japanese equities.
Exactly. And I should also say that as the yen appreciates, that will take the pressure off the Bank of Japan to keep hiking interest rates, because it becomes disinflationary. So the Bank of Japan's worries about inflation. So there is a self-correcting slowing down of the trend. It's just the sharp, catalyst that we'd be talking about. What is the catalyst for these moves? Well, if the yen starts to move, then that will be the catalyst for a big shift in other markets. But then it will be slowed down by what the Bank of Japan does through the appreciation of the currency.
And I think that's a really important point for all of our listeners to understand, is that any sharp moves in any sort of asset prices is always in danger of sort of causing a ripple effect or more danger. It's when things happen gradually. If this move in the yields in Japan was to take 3 years, markets would be able to absorb that very easily. For example, you were talking about maybe there being $17 trillion worth of yen carry trades. Well, I mean, the US stock market is valued at just under 60 trillion. The US bond market is over 40 trillion. So, in the overall scheme of things, because it won't come out one area in one day, if that happens gradually, I think markets would be able to absorb it. And I think, we'll see what the Bank of Japan says when they start talking about their intentions about maybe moving interest rates higher. Because as long as they keep a lid on it and say, we're not going to do this very quickly, we're going to make measurable, sort of slow and steady sort of actions to raise rates and raise yields and attractiveness of it, then I think markets can absorb it.
Stu, what do you think then? Spice touched on the market cap of US equities. That has substantially outperformed European equities and UK equities. Is 2026 going to be more of the same or different?
2026 is going to be an interesting one in terms of the dollar, because I think we are going to see further weakness in the dollar. A lot of the consensus is talking about some diversification out of the US, looking at how Europe has done in dollar terms this year. And that money tends to follow these moves. And so we talk about horses in the glue factory. It's a terrible expression.
What does that mean?
Yeah, what on earth does that mean? Horses in the glue factory.
Well,
I'm not sure many people listening have been talking about that so far in 2026.
Turkey's voting for Christmas.
Turkey's voting. Well, the least attractive horse in the glue factory is the currency that's going to be the weakest. So the best horse in the glue factory is the currency that's going to be the strongest. And, currencies are a relative game. And so if we're ranking currencies from top to bottom, I would say the yen is going to be one of the strongest currencies. The dollar is what is going to be one of the weakest. Sterling, with our politics, is unlikely to be a particularly strong currency. It, may well benefit against the US dollar if the US dollar is the worst horse in the glue factory. The euro definitely will see some strengthening because the euro, with the stimulus in Germany and the better outlook for Europe, it's all relative again. Europe is going to do better than it's done in the last 2 or 3 years. So that will attract capital.
From our portfolio point of view, if we do get a weaker dollar, we are actually ironically very well positioned for that because we've talked in previous episodes about the way commodities benefit from a weaker dollar because all commodities are priced in US dollars. And ironically, when the price of US dollars go down, the prices of commodities go up. And that would help our portfolio because right now we have about 22.5% of the portfolio in commodities. We've got a direct holding in a gold exchange traded commodity and in copper as well. We've got 7.5% in copper, 5% in gold, and we've got 10% in BlackRock World Mining. So we could actually, our position would ironically be quite well positioned for that outcome. The one counter I would say to that, and I would say this as a bull, particularly of the US and the US growth, is I believe that because by this time next year, the midterm elections in America will have been over. And they're a very important sort of lever for Trump's power going forward. He will therefore do everything he can in the first half and the first 2 and 3 quarters of next year in 2026, this year. And he will want to try and engineer growth, falling unemployment. And he's already largely set this up because he's got the one big beautiful bill. He's going to give you tax rebates because of the tariff rebates. He's going to give $2,000 to lower paid families. And that should stimulate that US growth. And if that is the case, then quite often, then obviously that attracts other money flows from other regions. And that's what you were using as an argument for Europe. Mm-hmm. I suspect that the European growth is probably going to be half of what it is in America. And that's being optimistic.
So if we were to ignore our bullish friend over there, who's just once again giving us exactly the bull
same
story,
as 2025, same as 2025.
Every time we even chat. And let us remember that we're here to ask you questions, Stu, rather than to lecture you. We've got 2 themes: the Japanese yen and a yield curve steepening, and the dollar being weak. What else is there, if there is anything else, that you think are the big themes for next year?
My third theme is inflation. Spice has just produced a bull case for the US, the boost to growth, then that's going to come with inflation. Now, the Fed recently said that it thought inflation might be lower towards the end of next year due to higher productivity. But to me, with the combination of weaker US dollar plus that strengthening growth in the US, with the stimulus adding to the AI investment, then we're looking at inflation remaining firm in the US. And that leads into the fourth theme, which is the Fed. Because, the Fed at the end of last year basically pushed out the idea that we're going to be substantially more cuts in 2026.
So I'm going to push you. I'm coming back.
Mhm.
Let's go to your third theme. Your third theme is higher inflation than is currently expected. Is that yes? Is that
Yes.
true?
Yeah.
Right. So if we think about that for our listeners, what does that mean for our listeners? What benefits from higher inflation, and what gets hurt by that higher inflation outlook? Where is that affecting asset prices?
Okay, so you're going to see higher inflation obviously harms the bond market. It
Okay.
lowers bond prices.
So bond yields go
pushes yields up.
prices go down.
Prices go down. It also steepens the yield curve because investors demand a higher risk premium for lending.
So
to
the
longer.
longer dated bonds sell off more than the shorter dated bonds because they need to offer more return. Yes?
Yes.
Okay.
Higher inflation also has a political implication for these midterm elections because it is going to harm Trump, which will make Trump more volatile as the year progresses.
Oh, right. Okay. So this is, it's the third theme is inflation, but it's not. The third theme is actually Trump becomes more volatile because the economy isn't doing what he expects. I'm putting words in your mouth. Is that?
No, yeah. That's part of the implications of that inflation theme.
So looking back, you think we are past peak Trump and that now his own electorate turn against him, the own party turn against him?
Absolutely. We've got this K-shaped economy, which is, the wealthy are doing very well. Those on much lower incomes are struggling with the cost of living crisis. Higher inflation or resilient inflation increases their concerns, increases their opposition towards the Republican candidates in the midterm elections. We get a divided Congress, which makes it legislation difficult to progress in the next couple of years. Trump becomes a lame duck president.
And K-shaped economy, for those people who are not intellectual with regard to the financial markets, what does that mean when you say K-shaped? Are you talking about the letter of the alphabet K?
Absolutely.
Well, how's that relevant then? Explain why that's relevant.
So you're looking at a graph there. That's absolutely perfect. What an artist!
People have said about that for many years, but not normally with respect to his drawing.
And that's what it looks like. So you've got those the top 50% or the top 10%, how they say, is providing roughly 40 to 50% of consumer demand at the moment. And then you've got the bottom 50% struggling with the cost of living crisis.
So the rich are getting richer and the poor are getting poorer is essentially what the K economy means. So three, and I think this, one of the things we used to do in these meetings was we would flesh out what these themes were, but obviously then it would hit people at various stages as to what actually the real message is. And the real message to me here, and something I'm going to be taking away just before we go on to the next one, is what that means for Trump and how he behaves. Because I think one of the best things about 2025 is he threatened to be cutting ugly and then behaved himself when the bond market started misbehaving. It's interesting if we think, and we'll obviously have to think about this and we'll debate it, but it's clearly interesting for all our listeners if Trump's going to start getting a bit out of order again because he doesn't like the way that economy is evolving. So that's quite an interesting theme in its own right.
I mean, I think that Trump's reaction is going to try and stimulate even more. Now, he can only do that before the midterms if he is going to lose some power in that. So he's already talked about these tariff checks. The risk is he puts more tariffs in, right? That's the risk. But I don't see that. I think that he's wants to see the cost of living come down, and he's already been pulling back on some tariffs because that has impacted the lower paid people and the poorer people because the cost of living has gone up because of the tariffs that he's put in place on bananas or coffee or whatever it happens to be. So I think that's important. But also a lesson to remember is that stock markets don't perform badly when you have a lame duck president. We've had many of them, and the US stock markets have had some of their best years when actually ironically, the person in charge doesn't have any power to do anything.
I wonder if his ability to do that, and what you're talking about is bring out more fiscal stimulus, his ability to do that is going to be governed by the bond market, and the bond market is going to be influenced by what happens with the Federal Reserve. Now, with this new governor, is it going to be the absolute do or death of the year who is appointed as Fed chairman?
I don't think so. I think we've had a lot of time to think about who the next governor is going to be. He's just one person on the committee. And I think that we are moving away from groupthink at the Fed. I think what we're going to see is much greater division within the committee. And that's going to be reflected in the votes. So in December, when the Fed cut, you were 9-3. There were 3 dissenters. I think we'll see much more dissent, which means more market volatility, as markets have to focus on each individual member of the FOMC. The dot plot within the FOMC becomes more interesting because investors are focusing on that. Of course, for the Fed, and what the Fed members are looking at is their view of what the natural rate of interest is. Now, the natural rate of interest is a rate in the economy that is neither stimulative nor contractionary. This rate is not observable, so it has to be estimated by each of the Fed governors. And it's roughly, for most people, the consensus is that the natural rate of interest is roughly around about 3.5%, which is why the market is now looking at very limited action from the Fed in 2026.
Because that's where we are right now.
Absolutely. Now, I personally believe that it is lower, but that is lower in the medium term. However, from a Fed perspective, with the K-shaped economy, that push to inflation not coming down next year, possibly even ticking up slightly with higher commodity prices, weaker dollar, stronger growth, then the Fed members will have to analyze that, and it will be a difficult decisions for many of them. And it's possible that by the end of the year, certainly, we will see markets start to price in higher interest rates.
Don't say that. It's a spice.
Well, at the moment, markets are pricing in higher interest rates in 6 countries around the world for 2026. I think we'll see more in 2026, which is another concern given this higher competition for capital.
So I'm going to actually hijack again your theme, and I'm going to say it's not really the Fed getting more, unsettled, because we all expect them to be unsettled. I mean, remember this. What we're trying to do here is predict difference from the consensus. I think people do think it's become much more difficult. I think the interesting thing is how many areas of the world will have higher interest rates at the end of the year than have now. Because if you genuinely said to anybody out there that US interest rates will be higher at the end of this year than they are now, then they would not have the views that people have on most asset classes. I'm not saying they're right or wrong. I'm just saying that's an interesting point to me. So, Stu, before we try and summarize what we think the effects and thoughts are around those themes and have more of a little bit of debate about it, are there any other themes?
There's one more theme, and that is politics. Look at the UK. We are expecting a bad result for Labour in the local Scottish and Welsh elections next May. That is likely to lead to a leadership challenge. If, as expected, Starmer is replaced, then he will be the 7th Prime Minister in 10 years. That is more than the previous 40 years. And it's just yet more evidence that politics is becoming more volatile. We talked about Trump potentially losing his majority in Congress, losing his authority to make big decisions, particularly fiscal decisions. And in the UK, I think that a change of prime minister will lead to another tax package next year.
Okay, Stu, that's fantastic. You've given us those themes. And remember, the point that we've been trying to get through today is what should be the themes that are going through our minds as we think about 2026, the rest of 2026, and as things develop, what should we have in the back of our mind? So these themes that I've got that I'm picking up here are yen strength, yield curve steepening generally. So longer bond yields prices going down, shorter bond yield prices probably not moving, meaning that we get a steeper yield curve, high yields at the long end, lower yields or flat yields at the shorter end. Third one was, I think, US dollar weakening. Then Trump getting a bit more irrational is a thought in there. And I think that's something that's definitely made my light bulb go off in my head. Then you talked about Fed interest rates, but I'm going to relate that to being where in the world are the rates going to be higher at the end of the year? Because that's going to be quite interesting. That's not been priced in some places. It is in others, obviously. And the final theme, I think, is more of a general theme about politics and how if we carry on with this K-shaped economy, remember, for everybody, the K-shaped economy, the rich do really well, the poor struggle because of the cost of living. If we carry on like that, what are the implications for more of this sort of fiscal policy, the tax and spend, and for the stability of governments, frankly? Okay, so that's what I'm taking out as the themes. Rich, Spice, what do you think to those themes? Are we missing anything obvious? Or are any of these themes, do you think, not actually that relevant?
I think that's a great sort of list of potential themes. Frankly, none of them really scare me as a bull. The two that would is if we got an unexpected rise in interest rates in the developed world, close to home, the UK or in the US. I think that could be quite damaging because it would go against what current expectations are. And as we talked earlier, talked in previous episodes, a catalyst like that could change people's perception. But I'm not worried about inflation because actually equities thrive with a modicum of inflation. You need quite high inflation at sort of 4, 5, 6% before equity investors get worried because, ironically, get worried because they think interest rates will have to go up to counter that. But any inflation up to about 4% is not really a problem, I think, for equities as long as interest rates are stable. So I don't worry about that. I don't worry about politics because, frankly, a politician who's is worried about maybe getting re-elected or their party doing better tends to be more stimulative, and they try and give away the goodies. So yes, the midterms in America, Trump is going to do what he can to try and get his party in a positive mode. In the UK, the Labour in the elections may go, do you know what? We need to be seen to be nicer and give away a few more things. So I'm not worried about the politics. It's only really if Trump turns around and says, I'm going to impose a load more tariffs, that would be shocking, and we could have another big natural impact there. So overall, from what you've said, clearly there are things to watch out for. But overall, I still believe that the big economies, particularly the US, will be able to shrug off pretty much all of those themes. And the rise in Japanese bond yields and the yen, I think, as long as it's modest and happens over a reasonable period of time, rather than dramatically impacting in one or 2 days or 1 or 2 weeks or 1 or 2 months, then I think the world can live with that.
I listened to my good friend Spice here, and he did drag me across to this darker side of the moon briefly at the start of December when I put on the bull jacket just for a little bit of Christmas festive fun. So it's fantastic to have Stu back on the show and just remind me of that cautious Scot inside me. But these themes are going to be played out, if they do come, at some point during the year or maybe even into 2027. And what we're trying to do here is, as Stu alluded to, dance close to the edge of the floor. So yes, we have got our investment portfolio in at the moment. What I would say is going into 2026, we need to get the listeners more comfortable that at certain points they can be sitting with a little bit of a pot in cash. Because during every year, there is a sell-off, a correction. Spice went through all the different categories of these pullbacks in the market. And you don't always have to be buying and looking for the next thing to buy. You can just, with consciousness that these themes could play out in a potentially negative way, it's always nice to have a little bit of a pot to step in when the market comes off. So, yes, I turned bullish, but it's nice just to know what the risks are on the horizon.
Once a bear, always a bear. I mean, I think there's a lot of good sense in what you say there. I'm more sort of relaxed, but watching these things develop. But what I do think there's another theme. Well, maybe a theme, may not be a theme, but another theme is AI getting in touch with reality. Because it's funny, we've talked about the themes and not one mention of AI, yet AI has driven all the movements in the markets. Now, if at some stage we start to see people saying, show me the money, as in that great film, I forget, but Tom Cruise, Jerry Maguire, show me the money. Sorry, I'm not an actor, you can tell why.
Louder, Jerry, louder.
Yeah, shut up, yeah. But if we get to a phase where that's happening, that could lead to a very difficult time because of the overrepresentation of these stocks within people's portfolios. Anybody who's got a global equity ETF has got a lot of money in these big stocks. I'm like Mark. That's probably a buying opportunity when it happens, but when it happens, it'll be uncomfortable. So that's something I would want to just think about as well as one of the things. But it's been really useful to think about all those things. And the great thing about these meetings is there's never going to be a conclusion as to which one is the most important. It's how, as the market develops, do we think we're moving into some of these, and what should we be doing in our portfolio? The one that's going to make me think a bit more about is the Trump gets more irrational one. That's the one I'm going to think about, because I think that's a good likelihood. Of all these things that are here, timing is uncertainty on most of them. But there is no uncertainty on the Trump one because he has to do it by the midterms. So that has to happen quite quickly. And it will be very interesting to see how that plays out. But, enough of that. I think, Stu, that's been a really, really, really good a conversation, identifying those themes, and hopefully gives our listeners something to think about whilst they're enjoying their hangovers after the New Year's Eve party a couple of nights ago. And then we'll have our podcast series starting again next week, and we'll start thinking about some of these things into our portfolio.
There is, of course, one final theme.
Oh, here we go.
The conviction trade. Scotland winning the World Cup.
And on that jovial note.
Right, well, that is your outlook for the year, the main themes to look at. And also a reminder that investing is an art. It's not a science. We can't tell when these things will happen, if they ever do. It's a real touch and feel, managing a portfolio, making sure that you batten down the hatches when you need to, but also take advantage of asset prices going higher when they're in the right mood. If you've got a question for us, then you know where to send it, gents.
The Art of Investing at IG.com.
So thanks very much for joining us on this Year Outlook special. Gentlemen, a very happy new year to you once again, and to you all at home. We'll see you next week.
Happy New Year.
Happy New Year.